let's say that you have a first mortgage, okay? I'm going to call it a first loan, a first mortgage, and you owe $190,000 on it, okay? And let's just say this is behind 3 months. Abbreviate months. Sorry, that looks like a 5. Okay, behind 3 months like it really was in this scenario here. So the first thing we got to ask ourselves is, well, what's the best? Every investor is going to ask this question. What's the highest and best use for the property? And what we realized was, well, it really only needs new carpets and a new hot water heater. But if we make those additions to the property, and this carpet was really bad. There were pets, there was urine in the carpet, it had a really nasty smell. So we figured that the after repair value, you see that, we call it ARV, is equal to 225. And I'm hoping that this is going to give you guys a really good idea of the way that, you know, not only us, but most investors look at property. Very simple stuff here. So 225, okay guys, and now we had repairs, hot water heater that the seller didn't have cash for, and the carpet, equal to about $6,000 that we took out of pocket to pay for that. Nothing crazy, okay? Now in addition, we had back payments, okay, which were some legal fees and arrearages that accrued over the 3 months of this loan being behind. Okay, back, I'm going to abbreviate that, and that was equivalent to $4,000. Okay, so that being said, you factor in what most investors are going to do also is they're going to factor in their closing costs, and these are costs associated with hiring an attorney, literally just getting the property sold and actually through closing. In this case, they came out to about $2,000. And what you also have to account for is a commission. A lot of these investors are going to have to put it back on the market, and they're going to hire a realtor to do that. I'm going to put commission percentage. So in this case, the commission would have came out to roughly $12,000 because of the fair market value of the property. So in this case, guys, the house was worth very close to the loan balance. It was worth, it was worth about $200,000. Okay? Now you have to understand, let's do this, okay? So you have a $190,000 loan, and that's the balance. You are now going to add another $6,000, $4,000, $2,000, and $12,000, and those are going to be your costs. So you're going to be into this property now for $214,000. Okay, so the typical investor asks themselves, is it worth just spending $214,000, which is really more than the property is worth as is, but a little less than what it is worth when it's all fixed up here? So is it worth $214,000 to cash for a $225,000 return? Okay, the answer for most investors, as you will see, is no. But they're looking at it whether it makes sense for them to pay, you know, in cash for this kind of return. So what really happens when you subtract this from 225 is you have an $11,000 gross profit. Okay, and gross basically means that you haven't even subtracted all the fees yet. Now this won't work, guys, simply because whether these investors are going to pay all cash, that $214,000, or they're going to go out and get a new mortgage, this $11,000 right here is going to get eaten up. In reality, on this deal, this investor would probably only make about $4,000. which, you know, ask yourself, does it justify the risk of buying a home, holding it, and fixing it for a couple months for a $4,000 profit after taxes if everything goes as planned? So this margin right here will get eaten up by, you know, holding costs, loan costs if you're getting a loan, capital gains taxes. So, you know, most people in this situation, guys, like a realtor would probably tell you, as a realtor, I am a realtor, most people, and this is how I would have thought of it before, is that, you know, look, you're going to have to short sale the property because it just doesn't make, the loan balance is too high for anybody to really profitably purchase this property. So, you know, in this example, the property would need to be bought by this investor for about $185,000, probably less, to justify the risk. And that's clearly not enough to cover the $190,000 loan, right? So I'll show you how we can afford to actually pay more. And in this example, what would happen is you would actually prevent a short sale from even happening in the first place. So let's take a look at how that works. I'm going to use this notebook here. So what happens is that let's say that you actually had some equity in the property, okay? So that there's money to be extracted, okay? So in the previous example, you really had no equity. And now let's say that we do have equity. So let's say that in the same example, you owed your loan balance is equal to $140,000. Okay, let's just say that $140,000. You would net technically your equity in the property. Again, using the same example as last time, okay? Your equity in this property would be about $30,000 to $40,000, and that's being conservative, okay? Now, take that same scenario. Again, the same scenario is the first scenario. But now, let's look at how we would buy this, guys. Okay, and again, I'm putting some equity in there so you could see how you would get your money out. What would happen here, guys, is I would take over responsibility for this defaulted loan. Okay? That means the loan stays where it is, and I am deeded the house. Now, I don't have to put a down payment in that amount when I'm doing this. If I'm taking over that $140,000 loan balance, and yes, this is legal, guys. A lot of people aren't aware of this, but I can take. There's a line on every real estate contract that says I can purchase a home subject to the existing financing. And what that basically means is that I'm simply taking over your payments for you. And there's a lot of benefits to that, which I'll cover in a second. But let's say that I take over the responsibility of the mortgage, okay? And let's say actually now that, let's use the previous example. Let's actually say that the loan balance, let's use the same amount as the previous example, and let's say that it's worth $190,000. The loan balance, that is the loan balance, okay? And I take over this, okay? I'm gonna start making payments on this. I drew this up here just so you guys could see, you know, what it would look like if you had equity in the property, because we would be able to get this out for you and actually give you that money.